Hello guys, welcome to your first lesson of the box system. In this lesson, we're going to understand what boxes are, how to draw them, and what to expect from the price when it breaks out of them. So first thing we need to understand clearly is that every single thing that trades in the market moves in two phases. Either the price is trending, which means it's creating a series of higher highs and higher lows, or lower highs and lower lows, or it's non-trending, which is whenever the market is not trending, it's just chopping around. So how do we identify these periods, the trending and the non-trending ones? Because that makes all the difference in what we should trade. You have to remember that when you trade one security, it means you're putting your money in it, which cannot be now used for trading anything else. That's opportunity cost, right? So if you're stuck with your money in a security which is just moving sideways for years, not moving up or down, you are just stuck with it. And you're wasting your time, you're wasting your energy, and that money is not making any more money, which is not how you want to do things. If you want to invest, try and invest in opportunities that compound fast. So let's see how to identify such opportunities today. So the first thing we begin is with zones. I will give you an idea of zones in this video, but I have created another video fully on zones explaining every single detail, and it's free for all members of HU 2.0 and War Room, so go check it out if you haven't already. So what are zones? Zones are important price levels which act as supports and resistances. In this case, for example, before I drew this box, let's identify some zones. Alright, you can see clearly that this price level is a zone. Why do I say that? I say that because look at this. Acted as support. As long as the price was above it, the path of least resistance was higher. Price crossed below it, the path of least resistance is lower. Acted as resistance here, price went lower. When the price went higher, acted as support again. Before price broke below, acted as resistance, price went lower. So all it means, a zone is a level above which the path of least resistance is higher and below which the path of least resistance is lower. You can see it acted as a resistance a bunch of times here, acted as support here before the price finally broke up. Same way we can define the top of this box boundary as a zone. I have drawn these boxes, but I will explain how you can draw them for yourself too. Let's identify the zones inside the box in black color. Alright. Is there another zone in this box? Let's see. This looks like a zone around 120. Same concept, acted as support. I can zoom in to see if the boundaries are correct. Maybe slightly lower because of the price action here. Perfect. Acted as support, price went higher. Acted as support again. When it went low, price went lower. Acted as resistance, price went lower. Alright, now in a similar fashion, I had defined this, the 101 level as a zone. You can see acted as support here, acted as the resistance when the price broke below, and I had defined this as a zone around 169.30 because it acted as a resistance a bunch of times. So once I had defined these zones, and you can define these zones if you are having any trouble finding the exact boundary for it, you can go to a lower time frame. Don't go anything below 4 hourly because then you will have a lot more noise, but you can go as low as 4 hourly to know the exact price at which the zone should be. Like this one, for example, can be slightly lower. When I'm making my watch list every single weekend, I'm very precise with this. But since it's an example, I'm not paying attention to a 50-cent difference here and there. Alright, so once you have defined these zones, you want to look out for periods in time when the price is not trending. It's not creating a series of higher highs and higher lows, or lower highs and lower lows. You see, it's just choppy. It's spending time between these two zones and just moving sideways. So what we can say is the price is not trending between these two zones, the $100 and the $169, and this are the box boundaries. These are your box boundaries. Boxes are simply helping us define the period in time where the price is not trending. It helps us define the price range in which it's not trending. What we can expect is once price breaks out of this box, it will trend. If it breaks out higher, it will trend higher. If it breaks out lower, it should trend lower. So that's how we define our boxes. How does this help us gain an edge? Because we can expect once the price is done consolidating here, which is when the collection by all the institutions is happening, those are the ones that will push the price higher, and then more and more people will get in, which will keep pushing the price higher. These boxes are the periods when the institutions are getting into stocks. They don't want to get in when the price is going higher. They don't want to get in when the price is going lower because they have too much capital to invest. So they like to get in small amounts over periods of time which are not trending. That's the accumulation phase for institutions. So once we have defined our box boundaries, we try to understand how the price will move out of them. The reason I've picked Roku as an example because it was a beautiful box in 2020 which broke out perfectly, and it will help us define many of the things we want to see or you should be looking out for when you're looking at boxes. All right, so once the price breaks out of this box boundary, it can move in three ways. One, it just directly goes, right? No issues, it just directly goes higher, no pullback. Those are the craziest one to catch because they move so fast, you want to pick up some profits expecting a pullback and they just keep going. The second way the price can move out of these boxes is it will go higher, pull back, retest the top of the box boundary, and then go higher. And the third way would be the price goes higher out of the box, comes back, retests the bottom of the first zone, and then it goes higher. You see, as long as the price is inside the box, this first zone is the low, right? Is the high will be the area where the price should not go below it if it wants to create a higher low. So if the price breaks out of this box, for example, in this case of Roku, it comes back and creates a low above this first zone, that's a higher low. You see, a higher high, higher low. And then it can move higher. So another higher high, higher low. So you see a trend has already begun in this case. This first zone is important because the price stayed above it in all three scenarios in which a breakout will happen. A direct breakout, a breakout retest of the box boundary, a breakout retest of the first zone, and then higher. Those are the three scenarios the price can go if the trend has started. So we know if the price falls below this first zone again, the trend hasn't started yet. It was a false breakout. We are still in a non-trending period. What it means is this first zone should act as your stop in every single case of boxes. Every single one. This is non-negotiable. You can find your own trailing stops based on your objectives. But if there's a box, this first zone is the stop in every single case. So like the stop I place in my trades is usually slightly below this first zone, because that allows for the retesting to happen and without getting me stopped out. All right, so once the price has broken out of this box, you see we have a trend starting. And what is a trend? In this case, it will be a series of higher highs and higher lows. We created a higher high here around 185, came back, created a higher low because the previous low was the first zone around 145. Now the higher low was around 153. Went back, created another higher high at 200, another higher low at 175, and voila, we had the bloat off part of this rally. So why am I explaining this trend, or why am I paying attention to this? Is because all trends have a certain structure. Once a trend starts, the price moves in a certain way. And once you understand how the price moves, it helps you anticipate what a trend should do. It helps you anticipate to get out in case the market breaks down or the price or the trend structure breaks down. In that, if the trend structure breaks down, you don't want to be involved anymore. You want to be out in cash safe because you don't know what the market is about to do. So let's see how the trend structure works. The trend structure, what I have noticed, is between two non-trending periods. The way things trend is it creates two sets of higher highs and higher lows. So Roku is a perfect example because it happened beautifully in this case. I will describe it properly in this one, and then we can discuss cases where it might not happen. But the usual trend structure is you have a breakout, you create your first higher high, you pull back, you create your first lower low, then you break out, then you go break out again, go above the first higher high to create your second higher high somewhere. We will have another pullback, and you will create a second higher low. This higher low, the second higher low has to be higher than the first higher low. Then the price starts going back up again, goes above this, above the second higher high, and this part of the rally now is a blow off top phase. In which case, this is the final part of the rally. And it ends, this part of the rally ends when the price moves below the low of the previous day. So you have to pay attention. You should be out of this trade as soon as the price moved below the low of the previous day in this part of the trend. So again, we have the first higher high, a pullback, a first higher low, all right, then a second higher high, second higher low, and then the last phase of the rally is blow off top. If at any point, let's say we created the first higher high, created the first higher low, created the second higher high, and then the price just falls back below this, the first higher low. In that case, the trend is over. The trend structure is broken down. We should not be in the trend anymore. We should be out. That's basically it. That's the trend structure. So in this example, in this video, we have learned about zones. There's another in detail video about zones, so go check that out. It's free in HU 2.0. Don't miss it. You have learned about how to create boxes. We have learned to figure out when a trend starts, what the price does when a trend starts. There are three possible scenarios, keep them in mind, and what the trend structure looks like. If the price stops following the trend structure, it means we have stopped trending. You want to be out of those. You don't want to be inside in a trade if it has stopped trending, because that's what's the point of it. You are setting yourself up for failure, either a deep pullback or just chop for months on end. We don't know. One last thing to mention is even though I mentioned that over every single market trends and has a trending period and non-trending period, there are some markets that trend better than others. What I have noticed is companies working on innovative technologies, growth stocks, they trend really well. Retirement stocks, dividend stocks, and forex doesn't really trend that well. There might be small trends here and there, but it's mostly very choppy. And I don't want to be sitting around trying to figure out a trend in retirement stocks to get a 5% gain when I can be in a tech stock and get a 50% gain in a year. So that's how I differentiate which universe of stocks to trade. All right, that's enough for the first video. In the next video, we'll learn about the types of boxes. All right, welcome back to second lesson of the box system. In this lesson, we'll discuss indicators and the different types of boxes you can expect to see in the markets. Let's continue with the example we picked up in the first video of Roku. And as I mentioned, it was a beautiful trend that developed in 2020, and it had all kinds of boxes that I would like to show. So let's start with it. First things, let's discuss the indicators. The two main indicators that I use are the 9-day moving average and the 50 moving average. You can use simple moving average, you can use exponential moving average, you can use weighted exponential moving average. It doesn't matter. They all are similar. Besides, indicators are exactly that. They're hints for decision making. They are not foolproof methods. I use simple moving averages, the 9 and the 50. You have to realize that markets are fractals. What happens on one time frame is similar to what happens on the other time frames. You will see the patterns that develop on weekly, they will develop on daily, they will develop on hourly. Maybe not in the minute or seconds because that's too much noise, but for the most part on higher time frames, the markets are fractals. So these 9 moving average and 50 moving average will be important on all time frames. I use them as such. The 9 moving average is my short-term momentum filter, and the 50 moving average is my medium-term momentum filter. If the price is above the 9 moving average, it's likely to keep going. It's likely that it has high momentum right now, and it should move fast and move higher fast. If the price falls below the 9 moving average, that means the short-term momentum is dying down. In which case, it might need to chop around for a bit, consolidate again, and then go higher, or it recovers the 9-day moving average within a day or two, and in that case, we are off again. So that's how I use them as filters. How do I use the 50 moving average as a filter? It's my medium-term momentum filter, so I only take box breakouts long if the price is above the 50 moving average. The same way, I only take breakouts short from a box if the price is below the 50 moving average. Because it describes the medium-term momentum, so we don't want to take a breakout that's against the 50 moving average. Because the price might face some resistance when it touches it, and that will lead to a failure of the breakout, and that's a very high likelihood, so I do not take those trends. Once you know how I use the 9 and 50 moving averages, let's look at the different kinds of boxes, and you will understand why I picked these two. Alright, so let's take Roku as the first example. You will see this massive box. Alright, let's begin with this. There are 3 types of boxes that I look at. One is this, a base box. A base box develops over a few weeks to a few months. Sometimes it's over years. That's a box developing on a weekly or a monthly time frame instead of a daily time frame. But base boxes can develop for a long time. If you want to see a base box that developed over a long period of time, look at gold from 2011 to 2018. That box developed over 7 years, and then the breakout happened and gold moved up fast and everyone was surprised. Why are you surprised? The price was consolidating in a region for 7 years. That's a lot of energy. That energy needs to be released. The price has to start moving. You can start thinking of price within these boxes as a coiled spring. The more it consolidates, the more energy it collects. So the bigger the box, the bigger the breakout will be. The longer the price will run because it has more energy. All right, so this box developed over months, that's a base box. You see, from these comes out the most beautiful trends that run for a long time. Once the price starts trending, we saw the trend structure in the last video. The price ran, then the trend structure broke down, and then it had to consolidate again. We were in a non-trending phase. So what usually happens after a base box is once the price breaks the trend structure, it starts consolidating again. It waits for the 50 MA to come and push it higher. That's what I have seen. You will see the 50 MA on the daily corresponds approximately to 9 MA on the weekly. So what you're actually seeing here is the 9 MA on the weekly pushing the price higher. So the second type of boxes which we usually see are 50 MA boxes. That's 50 MA on the daily. That's the one pushing the price higher. So it's consolidation, waiting for the 50 MA to come up, and boom, we go higher. So that's the second type of boxes. The first one, base box. The second one, 50 MA box. The third one, which are the smallest and do not trend for that long because as I said, smaller the boxes, the smaller the trend, are 9 MA boxes. You see them all the time. They are 3 or 4 days of consolidation where there can be a small pullback or just sideways consolidation and the price breaks higher. In this case, you will see here for 4 days, in this small box up here, for 4 days, the price is just moving sideways and then breaks out higher. These moves are usually quick, 1, 2 days, maybe 3, and then they die down. So that's the third type of boxes. You can call it a flag, you can call it a 9 MA box, whatever you like. Another one would be here. You see the price went higher quickly, so it moved sideways for the 9 MA to catch up, and then it went higher. Sometimes it's a flag. The price went high quickly, then it came slightly lower to touch the 9 MA, consolidated before it went higher. So that's the third type of box. It's a 9 MA box or a bullish flag, whatever you want to call it. So the three types of box we saw are the 50 MA box, the base box, and the 9 MA box. The most reliable ones in the breakout scenario are the 50 MA box. The problem with base boxes is sometimes the price can go out for a little bit, come back and keep chopping. But for 50 MA boxes, the first 50 MA box after a breakout, that's extremely reliable. The price just goes, as you can see in this Roku example. Another interesting case would be to look at Google. It has had 50 MA box after 50 MA box all of last year and this year, and that's what the price has been doing. I will draw some so you can get an idea. Okay, I don't know why the trading view is not letting me draw a box, but you can see between 1806 and 1700, you see a box here. It broke out. Then you see another box, broke out. All of these are 50 MA boxes. You see the 50 MA pushing the price higher? Google has done that all last year and this year. It's just 50 MA box after 50 MA box. Another one here, 2204 to 2400. Price went higher, retested it, boom. So now that we know the indicators I use and we know the different types of boxes, in the next class in the next lesson we will learn how to trade each kind of box, which option trades, which stocks, how to pick them, which option trade is better for which type of box. One thing I want to mention is, as I mentioned, markets are fractals. The 50 MA on the daily corresponds approximately to the 9 MA on the weekly. Similar way, the 50 MA on the hourly corresponds approximately to 9 MA on the daily. So when you're looking at a 9 MA box on the daily, that's a 50 MA box on the hourly. So you can look at it that way, and if multiple time frames have a point to in one direction, we'll make a decision in that direction. Buy. All right, that's enough for this class. The next class, we'll see how to trade each kind of boxes. See you then. Hello guys, welcome to the lesson 3 of the box system. Today, we'll discuss about system objectives. Now you guys understand what trends are, right? You understand their structure, you understand the different types of boxes, you understand how when the price gets out of a box, a new trend begins. So let's design a system based on this understanding of how the prices move in the markets so we can constantly benefit from that system. You know, we don't have to question it. The problem I see with many of the new traders is that they pick up a system, they don't fully understand it, its strengths, its weaknesses. They try it for a month or so, and if it doesn't work, they move to a new system. This cycle keeps repeating itself, and many such traders lose out over the long term. So this lesson is simply to decide what kind of system we want to create while keeping what our basic understanding of price movement, which we learned in the first 2 lessons, in mind. All right, so what your system objectives are, we first begin with what kind of markets you want to trade. As we discussed in the first video, that markets have 2 phases, right? One is trend following, one is mean reverting. Each security has certain properties which makes it more likely to be in one of the 2 categories. For example, growth stocks, they love to trend. They trend beautifully. While dividend stocks, retirement stocks, old companies, they don't trend as much. They are more choppy. They're more mean reverting. Forex markets, heavily bank dependent. Most of the trading happens between banks, and that's very mean reverting. It doesn't trend beautifully. Let's say commodities, they love to trend. If you catch a good trend in commodities, you can make a lot of money real quick. So the first thing we have to decide is what kind of markets we want to trade. Trend following, you might have, let me see, what are the advantages of trend following? The trend following advantages are you have to get in a trade and then you probably have to wait as the trend figures itself out. While mean reverting is more quick profits but small ones. Apart from that, you have to understand in your personality what you are really comfortable with. It's hard to say which one is better. I personally choose trend following because I have found that it allows you to compound your gains a lot faster than mean reverting systems. But again, feel free to use your knowledge about price movement to decide which one you would like better. Second thing, you have to figure out and you have to be clear about what you want to see in the markets before you decide to enter. So one thing, I'll give you an example. One thing I like to see before a box breakout is some sort of consolidation right at the edge of the box boundary. What that does is it reduces the chance of a breakout failure. If the price is coming straight from the bottom of the box, straight to the top and breaks out directly without any consolidation, I won't technically miss it. I would put half a position. But in ideal scenarios, I like it to consolidate at the resistance a bit, gain some more energy, and then push out with strength. So the chance of a failure is low. There are a couple other things that I like to look at, but this is what you have to think about when you're designing your system, is what I would like to look for in the market before entering a trade. The third thing you want to decide is what time frame you want to trade. It is very important to understand that each time frame has different mechanics, right? Like day trading is a bit more, I have found it's a bit more stressful. You can make quick profits, but you can also lose quickly. It's highly volatile, so your risk management has to be on par. It has to be on point. While if you're taking a bit of a bigger time frame, it's better for beginners because you can learn and your mistakes don't cost you as much. The trend system, the trend structure I described yesterday, it works pretty well, starting from 1 hourly time frames all the way to monthly, yearly time frames. So whatever your time frame you guys decide, the system should work really well. If you go down all the way to like 5 minute or 15 minute time frame, that's has a bit more noise. So the trend structure does not stay intact. So you have to keep that in mind if you decide to trade really small time frames. Then it also depends on your personality. Like I personally don't like to be in front of a screen for 8 hours a day while trading. No, I like to be able to make decisions, trading decisions from anywhere. All I need to do is look at the price once or twice, and that's it. That's all I need to make a trading decision, which is not really possible with very small time frames. So what I prefer is usually 4 hourly and daily time frames. But if you guys would like to go shorter or a lot longer, that's completely fine. The fourth thing you have to think about in your system is how do you plan to take an exit? Now, a bit of it depends on what market environment we are in. If the market environment is such that that stocks are trending beautifully, you can wait a bit based on your understanding of the trend structure and take a longer time to take profits. While if we are in an environment which is a bit mean reverting, you might want to think about taking profits quicker. As we learned in the trend structure, you have the first higher high, then a small pullback or consolidation to create a first higher low, then a second higher high, and so on. You can think about taking your profits at a first higher high, maybe partial profits, and then ride the rest. Or you can think about short-term trades where you just take the profits at the first higher push and that's it. You don't care about the rest of the trend structure. So this is something you'll have to decide for yourself based on what you're comfortable with. How much profits you're comfortable riding, how much capital you have. A lot of things, it depends on a lot of things, and a bit of it depends on your personality. So what I can give you in the next few videos is my system and how I trade it, but feel free to tweak it or modify it based on your system objectives, which we are discussing in this video, and your understanding of the types of boxes and the trend structure. The fifth thing you have to think about is the expectancy of the system. There are some systems who do really well, but maybe they only right 3 out of 10 times. Those 3 times they make a lot of money, and then 7 times when they only lose a small amount, right? That system can work, but you have to think, can you handle that many losses and not knowing when the wins will come? It might happen that your first eight trades are a loss. The wins are about to come, but they haven't yet. Can you handle that? So that's why the expectancy of the system is important, because once you know that your system is has positive expectancy and you're supposed to make profits over 1,000 trades, you will be a lot more confident and you will stick with it. My system, I personally cannot handle that many losses, or I don't like to. My systems usually have about 60 to 70% win rates. My day trading system is slightly lower, but in that case, my reward to risk is around 3 to 1 to 4 to 1. So I know these things intuitively, and that helps me stay confident in my system even during periods when I'm having some losses. Because trading is not 100% game. Like, there's no system in the world that will make you win every time. You have to learn how to handle losses and not let them get out of control. Small losses is fine, right? You will survive in trading as long as you have small losses, small profits, and big profits. The only thing that will make you go out of business is a big loss. So as long as you limit your loss, as long as you have chips left to play another day, we're gonna all make it. The last thing you want to understand is the capital you want to risk per trade. Now this is important and it highly depends on the expectancy of your system. It's important because, as I said, you might, if your expectancy, if your win rate is low and you're risking too much capital per trade, you might just be out of the game in the first 6 trades, right? So my personal capital I risk per trade is about 1 to 2% of my total portfolio. For some people, that's already a lot. But for me, that works really well. We learned in the first video that your stop inside the box system is always below the first zone inside the box. So any trade you will take with the box structure, your stop is already set. The price you're getting in is already set. So once you know how much capital you want to risk per trade, right, you will be able to decide your position size. You already have the buy-in price set, the stop set, and your risk set. So it will be easy to size accordingly and then take it trade after trade, just do it automatically without ever having to think how much the position should be and other questions like that. So have these objectives on the side as we go through the rest of the videos, trying to understand my system and how you can use the box structure and the trend structure and the types of boxes for different kinds of trades. Think about these questions of the system objectives, understand your objectives, and once you're very clear about them, trading will become a lot easier. All right, that's all for this video. See you in lesson 4.